Hello and welcome to yet another live session, and today's session we are going to dissect upon how you can use the Excel screening tool for your advantage. I'm going to go deep dive in terms of understanding different components of your Excel screening. That is, we'll go deeper into income statement, we'll go deeper into balance sheet, and how you will analyze the cash flow statement along with ratio analysis and a lot of deep dive within it. So if you are ready for today's session, just type ready, and it's going to be epic session in terms of what you are going to learn in this particular video. Okay, so let's get started, and if all of you are ready, just type ready in the comment box. Awesome. So hope all of you have downloaded the Excel screener template first, right? So if you are not downloaded, I'll just give you the link so that all of you can get started along with me. The link is also there in your chat bot, and also it is there on your description below. If you are still not able to find, I've just flashed it on the screen. Okay, so make sure you have this Excel open in front of you so that you can go step by step. And this is going to be like a very detailed session. I'll go deep dive. We will spend like around 45 minutes doing this so that your entire concept around screening is super clear and you are well versed by using this tool, how we are going to approach this entire process. Okay, so first download this Excel if you are not yet done it. If you already downloaded, please open your Excel so that when I'm talking about this Excel, you can go step by step and you can understand exactly how to navigate this particular Excel. Okay, so I'm sharing my screen and showing you what the Excel will look like. Okay, so when you have downloaded the Excel, this is what the Excel will look like. And what will happen is you might be asked, okay, whether you need to allow the add-in to be installed or allow macro or some kind of notification might come in. So make sure that you check yes for any kind of such notification so that you can use this entire template very smoothly. Okay. Another very important thing before even we get started is this data sheet is very important. Okay, it's where the data from the screener template is getting flown automatically when you upload this template. So don't play anything with this data sheet. Don't make any changes, don't delete any cell, don't change any of these things inside this particular sheet. Anything else which you want to change, you can practically change it, but leave this red colored data sheet which is having the data which is flowing through entire Excel sheet. Okay, so make sure you don't play around with that particular tab. Now what you need to do is you need to go to this particular step. Okay, so all the steps are mentioned step by step. So the first step this is mentioned is this Excel is customized to be used on screener.in website only. So don't go to any other website and say, Vivek, it's not working, because it's meant to be used in screener.in website only. And you don't need a paid account for it. You can pretty much do it with a free account on screener.in. Okay, so that is the first thing. The second thing is you need to sign up if you are not signed up to use this particular tool. If you're not logged in, you might not be able to use this tool. So you can just do a free sign up. You can do a Google sign in, and that is where you will be able to use this. Now the third step you need to do is just copy this link which I've given to you in the Excel sheet itself, and just paste it there. Okay, so you'll get screener.in/Excel. Just click on that and choose the file which I have given to all of you. Okay, so I'll just go to my folder. Okay, and I'll upload this. Okay, so I'll go to this my folder, and I've already uploaded, so I'm not showing you, but you can just go and do that step. Okay, so just upload and click on the upload button. Okay, so right now I'm not attached the file, so it will not allow me to upload, but that's totally fine. Okay, so you just click on upload and your upload sheet will be getting uploaded. Okay, so whatever sheet I've shared with you, you just choose the path where you have saved that and click on upload, and you are done. Okay, now once you have done that, you can go to any company which you want. Okay, so say for example, I go to Page Industries, and if I go to Page Industries, there will be this export to Excel button. Can you see export to Excel button. All of you are able to see this. Just type yes if you are able to see it. You can click on this button and automatically, if you see, there is a page industry Excel that has popped up. So now my template which was there, that has been customized for, page industries. And you can see here, okay, Excel version 3.0. You should all have version 3.0. This is the base Excel which I had, version 3.0. It will look exactly same. Only difference will be in the name of the company. So here the template which I gave you was with the name of Vinati Organics, right? And if I go to that particular template and show the name, which company name it is appearing, it will be Page Industries, right? So let me just again move my cursor here and you can see Page Industries is popping up there. So that means the template is downloading correctly. Okay, so this is the first step. All of you understood the first step. I'm going slightly slow initially, but we'll pick up the speed as we progress. But this first step is very, very important. Okay, otherwise you will not be able to move forward and navigate inside this entire template itself. Okay, so that's why I'm spending slightly more time. Now on the overview page, there are different instructions that are mentioned. Okay, so the first thing is don't change the data sheet as I mentioned. Second is, if it asks for enable editing before using the template, please enable editing so that all the data flows properly. And the video which we are recording right now will be your tutorial. So if you click on this green button, anytime in future you need help and you want to watch this video again, you will be able to watch it. And then there are a lot of other resources which I have given to you. You can explore them. You can connect with me on different platforms. That is what you can do here. Now, second tab, which is very, very important, is called Overview tab. Now, what does Overview tab contains? It contains first the link to all the sheets which are out there, right? So this is your home button basically. Anywhere you want to go throughout inside this Excel, this is the tab you should be using. Okay, so if you want to go to instruction tab, you will go there. And if you want to again go back to the overview tab, just click on the go to overview tab and you will be coming back over here. Okay, so each and every, Excel sheet, the bottom link will be given back to the navigation menu. Okay, so it will take you back to the overview. And from overview, you can go to any other Excel sheet tab, which is provided to all of you. Okay. Is this clear? This is how, meticulously and very, very detailed, neat way this is prepared for all of you. Okay. Then you have income statement, which is your yearly income statement, which is given to you. So you have almost like a 10-year data right from 2013 to 2022. And then you have trailing 12 months, that is TTM data, last 12 months data also available. Income statement quarterly, you have quarterly income statements. Okay, so for last, I think around 10 to 12 quarters, you will have data over here. So right now from June 20 to September 2022, you have the entire sequential data of your quarterly income statement. Then the third tab is your balance sheet, where you will get overview about all the balance sheet items. Then you have cash flow. Different ratios which we have calculated from income statement, balance sheet and cash flow will appear here. And then finally we have Dupont analysis, which is very, very powerful analysis. I'll talk more about it later on and I'll explain you how you can make more money and understand company and analyze a company in a much deeper way using this particular tool of Dupont analysis. And finally, there are a couple of graphs which I have given and you can add anything over here. Okay, if you want to add more graphs, if you want to tweak the color, if you want to change the color, I've given you all the access rights to change it. And what you need to do is you change the template and then you upload the saved version of that template to make all the new future downloads with your changes applicable on the downloads. Okay, so that is how this entire sheet is done. And as I mentioned, each tab there is a navigation menu. So you click there and you come back to your original sheet. So if this was very, very powerful for all of you, just type powerful in the comment box. This is the first, navigation, how you need to do in the Excel. So each and every tab, the navigation is very simple. Click on the button and it will take you to and fro into this entire sheet. Now let's come to the key data points. Okay, so as soon as you land on this particular Excel, and I'll slightly, take my face this side so that all of you can see this. So if you see, there is a key overview about the company. So make sure that whatever company you have downloaded, the name is matching. That means the data is downloaded correctly, right? So if you go to the previous sheet, which I was mentioning, there is Page Industries, which is mentioned here. Now, if we go to the original sheet, it is Vinati Organics, which is mentioned here, which means the company name is correctly pulling. It will show you the current market price. It will show you the number of shares. It will show you the market cap of that company in crores. And it will also give you the basic ratios and net profit in the last 12 months, what has happened. So basically it gives a bird's eye view about the company. Okay, what is the net profit? What is ROE? What is ROC? What is price to earning multiple? What is the kind of market cap? And what is the current price of that company? So that is all about this particular sheet. Now what we'll do is we'll go deeper in terms of understanding the income statement. But let's first understand why we are, dissecting and analyzing all these things, right? Why we are doing this is to achieve our goal. What is our goal? Our goal is to beat benchmark returns by at least 10%, right? So if Nifty is overall compounding at a rate of 15%, our idea is to compound it to 25% so that we achieve our financial freedom in a much faster way. And to do that, what I do is I have two parts of the portfolio. The first part is core portfolio, right? So the core portfolio, the focus is consistent compounding. All of you just type CC in the comment box, consistent compounding over a long period of time. So here you choose businesses which has proven track record. You are able to get in at a reasonable valuation, and they keep on compounding for future also. So you avoid any kind of cyclical companies which are there. So you avoid companies which are in sugar sector, in paper sector, into steel industry. All those companies, you don't keep it in your core portfolio. For that, what I use is satellite portfolio. So the core portfolio is a 70% overall in terms of portfolio construct, and remaining 30% is the satellite portfolio. Now this Excel will be very helpful to all of you for doing your core portfolio analysis. Your satellite stocks will move much faster. It will not have a consistency in terms of earnings and everything. So I would recommend all of you to not use this for your satellite portfolio. Of course, you can get data point. You can use some of the insights in terms of how the sector behaved earlier and all those things. But predominantly, it will be used for your core portfolio screening. Okay. And if you want to know more about this entire process of core and satellite, you can watch my previous video, which is there on this channel itself. It is called How to Outperform Nifty Return. So I'm not going to go deep dive inside this, but just as a precaution, I'm telling you that this is meant for companies which are in your core portfolio. Okay. Now that with that context, you will be able to understand why I'm telling this and what to look for inside this entire journey. Okay. So the first thing which I do for my core portfolio screening is called machine formula. Okay. So I've devised this entire formula to screen stocks into your core portfolio. The first thing which we should be looking is how the company is placed in terms of its mega trends. Okay. Are there any mega trends which are helping this company to grow consistently for a long period of time? And for that, you need to look at some of the structural things happening in the company, whether the sector is growing for a long period of time, whether the company sales is growing for a long period of time, whether the margins are stable or increasing and they are, continuously helping your net profit to grow. And that is where, we go to the income statement. Okay. And if you see, all the things which are important in terms of long-term growth trends are being analyzed in this particular sheet. So if you see, the first thing which is starting point of this particular income statement is sales. Can anyone tell me what is the importance of income statement? Like why even we look at income statement? Can you type in the comment box? What is the purpose of analyzing the income statement in the first place? Yeah, some of you are saying we analyze because that is what captures the core operations. Yes, absolutely. What else? Okay, you can measure what is coming inside the company in terms of sales and what is going outside the company in terms of expenses. And that leaves us with the net profit, what is left for the business owners or the shareholders of that company. Okay. What else we do with the income statement? Yeah, we know what are the components through which the sales is coming, and what are the components through which the expenses are going off, right? So some expense might be going for rent, some might be in depreciation, some might be electricity bill. So you get to know what are the different components, and hence you can control your expenses and income in a better way. As a decision maker of the company, you can analyze them much better. And as a shareholder, when you are analyzing a company, you know how is the focus of the company, whether they are saving on expenses every year, whether they are trying to improve the sales, whether they are able to protect the margins every single year. Yes. So that is where, to understand the mega trend of any company, you have the first line item, which is sales growth. And that is where, you are given a 9-year growth, what is 5-year growth, what is 3-year growth, how is the consistency. And you can also see year-on-year growth over here. Okay. So if you see in year of, 2016, there was some issue, your sales growth dipped, your EBITDA growth dipped drastically, and your PAT growth also dipped drastically. So rather than, just sitting and saying, okay, I'm a long-term investor and let me read the annual reports of 10 years to understand the company, just have a glance through on this Excel and try to go to 2015 and 16 annual report and see what has happened because of which this degrowth happened. Same way, if you see the year of 2020, of course, it could be because of COVID and all that, but there also there was some dip that has happened. And even in 2018, there was a fall in the profit growth drastically. So rather than going everywhere, you just go and check what has happened in these years because of which this aberration has happened. Okay, so that is how you use this Excel in an effective way. Then you want to check whether my sales growth is also translating into my profit growth. So you see what is the growth trend in terms of sales, and at the same time you have an overview of your profit growth also. So if your sales is growing but your profit is not growing, what does that mean? It means that your expenses are increasing more than your revenue. So your margins are getting compressed, right? If your salary is increasing every year 10,000 rupees, but your home expenses are increasing every year 20,000 rupees. Are you going to have more savings or net income at the end of the day? The answer is no. Okay. And that is what is very, very powerful to measure, which is called operating profit margins. In terms of operations, whatever profit you are making, you divide that by sales. What is that you are left with? Now, it is very also important to understand what is the consistency in terms of operating margins. If the margins are cyclical, like if it is 1 year 20%, second year 10%, then minus 5%, then again it goes to say 5%, then again goes to 25%, what does that indicate? If the margins are fluctuating very, very frequently, what does that imply in terms of your analysis for the company? Just type in the comment box. Okay. Yeah, absolutely. So if your margins are fluctuating very frequently, it means your company is cyclical in nature, and that should not be ideally part of your core portfolio. Are you getting it? How in a just glance of one line item, you can actually measure what is happening. And if you're not familiar with the financial statements, I would highly recommend you go through some of the other videos in my channel. I have a detailed video in terms of financial ratios. You can just search with Vivek Mashrani financial ratios and you will get that video. But these are very basic ratios which gives you a lot of insights about the company. Okay. Another thing which the operating margin will help you assess is called competitive advantages. Okay. Now, if a company is consistently making a lot of money and a high margin, like 20% margin, 15% operating margin, can you tell me how does it indicate something about competitive advantage? Just type in the comment box. Okay. How a company making a consistently higher margins and also growing consistently is better in terms of competitive advantages. Okay. Yeah. So basically those companies are having higher pricing power. Okay. So imagine that during COVID, if any company had a monopoly drug, like only that company is able to make a drug which is helping COVID patients. And a salesman of that company goes to a pharmacy store and he says that, okay, I can give you this medicine for your patients, but you need to give money in advance, and my margins are like around 20%. Okay. So what will happen is that pharmacist will still buy that product even if it is at a higher margin. And another thing which will happen is the pricing power, right? You will not get much of credit, so your receivable days will be much lower, which we will learn also when we are learning the balance sheet. You will be able to connect the dots. But a consistently high operating margin means something the company is doing really good and they are able to maintain this. If this is clear so far, just type super clear in the comment box. Okay, so that is on the operating margin front, and same with the net profit margin. Okay, it also gives you an idea of whether the company is high volume player or kind of premium player. So any kind of premium company, okay, so if you go through, say for example, Louis Vuitton's operating margins, their margins will be very high because they are selling premium high margin products, and their net profit margins will also be high because they are selling premium products. But if you open up something like D-Mart, their net profit margins might be much lesser, but they might be playing a volume game. Okay, so that also is the insight you will get from this particular data points. Then next very important thing is tax payout. Okay, chor bane more. There are a lot of companies which appear to be like a good company, but if you see the tax outflow, they are cutting corners on taxes and they are not good in terms of corporate governance. So this is what you can assess when you analyze the tax payout ratio. And if there is a sudden dip or increase, you need to ask why this is happening. Okay, always ask why. Just type AW in the comment box. Wherever there is aberration, and that is where all these sheets are colored very beautifully in terms of green and red. So if there is a dip in 2021, if there is a dip over here, you need to ask why this is happening. Okay, even if you don't know 100% about these ratios, just with the color code, there is some aberration that is happening. And if that aberration is very wide, you need to ask why. Okay, then you have a very important metric which is called interest coverage ratio. Now what is interest coverage ratio? If you double click on this, you will see interest divided by PBT. So say for example, you are taking back home, and PBT, we are also deducting back the interest. So it is like a net EBITDA, which is, calculated here. So say for example, you are getting a salary of 1 lakh rupees per month. Okay. And from that 1 lakh rupees, after all the taxes and everything, you are left with say 50,000 rupees. And you have a home EMI where the interest component, I'm not talking about the entire EMI, the interest component is say 10,000 rupees. So what does it mean is your EBITDA or operating profit, whatever 50,000 rupees is there, it is able to cover this interest 5 times. Okay, so your interest coverage ratio is 5x. Now what happens if your interest coverage ratio is just 1x? Means your interest is 50,000 rupees and whatever you are left with after the salary is just 50,000 rupees. Will you be able to even repay the principal any point of time? Absolutely not. So the higher the interest coverage ratio, the stronger and the better the company is in terms of repaying its interest to its creditors. If this is clear, just type clear in the comment box. So that's where, at least the interest coverage ratio you should be seeing is 3 times. And it should not decline or deteriorate in their journey. Now this company is almost debt free, so you will see very high number, more than like 200x, 300x. But for companies which are leveraged, you will even see like 3x, 4x kind of ratios, or sometimes even 2x. If it is less than 3x, you need to get alarmed that this company might not be sustainable in terms of the kind of debt which it has taken. Then of course we have a PE ratio, which also signifies what is the multiple the market is giving. And the most important thing which I've done here is, as I was saying, the importance of your income statement is that you can see where the money is coming in, like where the sales is happening, and also you can measure where the money is going out. And that is where we have all the different components of expenses which are laid down here. So say for example, a company is mentioning in its con call or annual report that our raw material expenses are coming down. You can just quickly check whether it is really coming down in terms of percentage. Or say for example, in 2020, management promised that, okay, we will try to bring in our raw material cost down in next 1 or 2 years. And you just go fast forward and check whether management walked the talk or the raw material prices actually started increasing. If they say, okay, we are going to manage our employee cost and we'll try to reduce the burden from the salaries. And if they have spoken in like 2021 and their cost overall was 8% going into the employee salary, you then check whether it has actually gone down or not. Okay. And same way, you can check whether they are, on an increasing margin territory or decreasing, and all these numbers you can just cross check, like everything ties back. So you can see operating margins here, 27%, it is 27%. So it actually gives you the breakup of how the operating margins are getting impacted in its journey. Okay. So this is about income statement, and then year on year you can see the profit growth and EBITDA growth, how is the trajectory and how they are doing every single year in their journey. Now this is very important to find out whether you have got a core compounding company or not, because your satellite companies or companies which are having fluctuation in terms of cyclicity, they will have very, very cyclical growth rates, and they will also have cyclicity in terms of net profits which are captured here. So this is about income statement. If you understood this, just type super clear in the comment box. And those same things are there in terms of quarterly statements also. There are fewer line items available based on the disclosure which company does. Then next, let's go to the balance sheet part of the things. Okay, so I'm just zooming it a bit so that all of you can see it properly. Now, can anyone tell me why do we even look at balance sheet? Like what is so important about balance sheet that we are analyzing it right now? Okay. Superb. Great. So balance sheet is a snapshot of a company at a particular time. Okay. So what balance sheet does is it will give you an insight of where the company is right now. Okay. So that is where, it is very, very important to understand the logic and the, idea around this entire balance sheet part. Now, let's understand with a very, very simple terminology how the balance sheet gets formed, right? So say for example, I start the business, and if I start the business and I've got in say 1 crore rupees inside the business, that is, I'm putting inside a company, and the company is liable to pay me as a shareholder, right? So it's my equity which I'm putting there. So what will happen is the company on the asset side, now company has some cash which is their assets, it will show it on the asset side of it. And remember, balance sheet should always match. Like if there is a 1 crore on asset side, there should be 1 crore on the liability side also. So it will show liability as an equity, of shareholders. This is the shareholders' equity. Okay. Now, what if this company wants 1 more crore and say promoter doesn't have, or the shareholder doesn't have that 1 crore rupees with them? What will happen? Okay. So it will borrow from somebody else. Okay, it will borrow from somebody else. And if they borrow, what will happen? If they borrow, it will show it as a liability side, 1 more crore, from banks or whoever they have borrowed it. And that is how the balance sheet starts forming, right? So if you see, there is, this equity share capital, which has been brought up by the shareholders. Then you have reserves, which is all the profit which keeps getting added, right? That keeps getting added in the assets, in the reserve side. And then there are assets against it basically. And then you have borrowings. This borrowing is basically somebody external who is giving money to the company. And then finally you have other liabilities and all those things. Okay, so this is how you will get a picture of how the company is doing in terms of its overall health. Okay, if this is clear to all of you, just type super clear in the comment box. Okay, so now you got an idea how the company is getting money and where the company is spending money. Now, what is the most important spending the company can do? Can anyone type in the comment box, like what is the most important allocation where the company can do for its future growth? Should it do it in fixed asset, or they just put money somewhere in a fixed deposit or FD? What should the company do? So the company should ideally put money, and most importantly, if it has a good return on capital employed. Now there is a very, very interesting thing which all of you should know, which is called ROCE. And even in my machine formula, I cover that. Okay, so I'll just show you the screen so that all of you can understand. So we have understood the mega trend part of it. We have understood the competitive advantage part of it, like a company which is very, very strong. Now high ROCE is very, very important, and I share this inside my community also in terms of tree analogy. Okay, now not all businesses are good in terms of putting money. Okay, you need to see whether they are really having good moats. I have a detailed video on that. You just type what are economic moats and how to identify a company with economic moats. You will get a video around it on my channel. But the important part is how much return you are getting on the money you are putting, right? ROI or ROE or ROCE, that is the metric. Like it, even right now you might be thinking, right, that if I'm sitting for 1 hour listening to Vivek's video, am I going to get value around it? Am I going to learn new thing around it? And what is my learning divided by time? Okay, and hope all of you are finding this session very, very valuable. If you are finding it valuable, just hit a thumbs up. And also don't forget to subscribe this channel if you are not yet done so that you can get a lot of such valuable content. So same way, when you are putting money for company's growth, you get to know whether I'm generating enough returns out of it or not. So say for example, I say if I invest 1 crore rupees and I get 7 lakh rupees as a return. Okay, so return on capital employed is 7%. And my FD rates are 8%. Should I put money into the business? Should I buy fixed asset and keep doing the business, or I just shut my shop, put my money into FD and chill on the beaches of Goa? What should I do? Okay, just chill. That's it. So your ROCE is a very, very important metric in terms of decision making, whether you should invest that money back to the business or you should give that money to the shareholder. Just give it out as a dividend. Don't use that money to put it at a futile asset. Just do FD instead. Okay. So that is where, you need to find businesses which are high ROCE in business. Minimum 15% of ROCE in the Indian context, you need to check it out. Okay. And that's where this Excel sheet will be very, very beneficial, because we have calculated return on equity and return on capital employed. Now, the only difference here is if you are borrowing money, still you need to, see what is the return you are getting. So that is return on total capital employed, whether it is Vivek's money or whether it is a money coming from the loan. And ROE is only the shareholders' money. Those who have put in like initial 1 crore, how much return you are generating for them. Now, if you see in this particular example, consistently it is making over like 15% ROCE. But for some years, it is drastically dipping. And all the other ratios are also getting red. That is where again, what you need to do? Ask why. Why this ROCE is dipping? What is the decision that company has made? And sometimes it can dip because you might have put in money into a machinery or a fixed asset, but it is still under construction, right? I have ordered a laptop, but I have not yet received the laptop. How will I generate revenue out of it? Right? I've ordered a power plant, but that power plant is not yet installed. So for 1 or 2 years, it will take time for that machine to run at an optimum capacity, and then it will start giving back money to me. So sometimes it's totally okay, but you should know the reason. And to know the reasons, you should analyze this particular part, right? So here it is exactly what that has happened. So 2019, your fixed assets were 474 crores. And then 2020, you had 751 crore worth of asset. That means, company did a significantly big capex, and probably, they are just starting to commission it. And that's where there is one more metric which is very important, which is called asset turnover or net fixed asset turnover. Assume that I'm using this computer. Say my laptop is like MacBook Pro, 2 lakh rupees worth of fixed asset. And say, for example, I'm doing some activity, say I'm doing some job work or some freelancing work. And if I'm working for, say 8 hours a day, in a year, assume that I'm making 20,000 rupees. Okay. So the revenue divided by your fixed asset turn, like how much time you are able to turn it, that is what is given here, right? So you can see like what is the income you are generating, and you divide it by your average of fixed assets which you are using. Now, sometimes, while using a 2 lakh rupees laptop, I can do a job work where I can earn even, say 4 lakh rupees. Then your net fixed asset turnover is like 2 times. Okay. And if it goes down, you know that I'm not probably working efficiently, or from 8 hours, I've gone down to 6 hours. Now, what if I start working for like 16 hours a day? Do I need one more laptop to do that? The answer is no. I can work in double shift and I can squeeze my asset much more than earlier, and I can increase my next fixed asset turnover. And what if I'm installing a new machinery and it is not still fully in utilization? My net fixed asset turnover will go down. Okay, so this is how you can get a lot of insights from this Excel. This is how very, very thoughtfully it is made, and all the data points you need as an investor to think about and to analyze a particular thing is mentioned here. Okay, now some of you are asking that, okay, once I've downloaded this and I start using it, what if I need to go for understanding all these data points, how to read annual report? So I have a specific video on this channel. You can just search with how to read annual report Vivek Mashrani, and you will find that annual report video also. I've specifically covered how to exactly look at all these data points and make sense of all these data points. Okay. Now we have a question which I'll just take it while we are on this topic. So we have a question from Rajan, who is saying, when I download it, downloads as version 2, that is the old version which I gave you earlier, how to remove version 1 and upload version 3. So simply go to the same steps. Okay, so you go to screener.in/excel and then upload this new version. Automatically the new version will take effect of the template. Okay, so that is how you can do it. Now, any doubts so far which you have, guys? We have covered briefly about income statement. We have gone deeper in terms of balance sheet. What does ROC means? Why ROE is important? Why net fixed asset turnover is important? And also, as I said, there is one more thing which signifies the pricing power of a company, which is receivable days. Like how much are you able to give as a credit to your suppliers, right? So if you are able to squeeze your suppliers, like if you give lesser and lesser credit, that means you have some pricing power, your product is in demand. Maybe, your customers are paying you upfront, or they are paying you in advance, or they are paying you in a very, very short period of time. That means you have got some niche product which is very valuable in the eyes of your customers. And if that number is increasing, then it is again alarming, right? So from say March 19, it was 68 days, then it went to 79 days, then it went to 92 days. What does 92 days mean? It means your average credit outstanding is around 3 months. Okay, so from almost like 2.2 months, now your credit period has gone to 3 months. Now it can be some industry-wide practice that has changed it, or it can be because you are not able to sell your goods and you are giving more credit to your customers, or sometimes when companies are doing some fraud, they might be just putting fake revenues which is not coming back to the company. Okay, so this is how you can take idea about this entire powerful concept of competitive advantage, right? This is called moats, like how competitive your company is and how powerful you are in terms of pricing power. So your ROCEs, your operating margins, your receivable days, all this will signify how powerful you are in terms of competitive advantages. Okay. And then, you have a breakup of your balance sheet, like whether your fixed asset is a major chunk, whether, your balance sheet is getting diluted in some other assets, like in this case, a lot of other assets are forming. So that also gives you an idea of asking why this is happening, where they are putting money, why they are diverting money from fixed asset to somewhere else. All these questions you can ask. You can see in their con call, you can check it out, their credit rating reports, you can read their annual reports to dig further. Now, this is one more powerful idea I want to leave all of you with, is this will happen only when you build your systems. Okay. So always build your systems to first screen the list of the companies which you want to, start researching, then research those companies. And while you are doing those research, you ask why this number is off, why this is happening, why it is not on track. Most of the people do the opposite thing. What they do is they randomly, go through each and every company. They watch news all the time and they get distracted. Like then they don't know what exactly to do. Okay, I want all of you to do reverse thing. Like first focus on the list of few companies, and if you need help, I do a separate session, a masterclass. If you are not part of my community, you can just note down this address, which is technofunda.co/webinar. You can join that session. And once you have a list of the companies which you want to focus in, then you go reverse and then ask why, rather than spending your time reading random annual reports, watching companies randomly on the TV screen. Okay. So if this was bulb on, just type bulb on in the comment box, because today's time and age, focus is very, very important thing if you want to really achieve your financial freedom. If you don't have a focus on fewer things, then you'll always be distracted. Okay. Now let's come to the cash flow side of the things. If you are ready for the cash flow understanding, just type CF cash flow in the comment box and let's go to the cash flow. Now the cash flow is basically the real thing. Okay, whether the real money is coming in or not. You can have fake revenue because all the income statement items are accrual basis. What do you mean by accrual basis? So say for example, in right now the video, we have Aditya who is watching this video. So if I'm selling something to Aditya worth say 1,000 rupees and Aditya doesn't pay me, I can immediately book revenue. I can say, hey, I got 1,000 rupees worth of business from Aditya, and Aditya forgets to pay Vivek that, okay, I need to pay this company or Vivek 1,000 rupees. Still that revenue will be booked. I might have made actual expenses. Okay. So I might have paid 400 rupees of electricity bill, which have gone from my account. Okay. I've not still received 1,000 rupees, but still I can say, hey, I earned 600 rupees worth of net profit, assuming the tax and interest and everything is zero. Okay. So that is called accrual system of accounting. Like even if you are not actually received the cash from Aditya, still I can book in my, revenue in my income statement and I show it as a profit. But what will my cash flow statement show? My cash flow statement will show that Aditya has given 0 rupees to me and my cash outgo in my electricity bill is 400. So my cash flow statement will show minus 400 rupees. It will not show me the inflow. And that is where the most important item to look for is the cash flow from operations. Whatever operations or the business I am running, whether that profit from the accrual part is actually got converted into the cash. Now, sometimes genuinely it can happen, Aditya pays me after 1 month now. Right now it could be March and, next year he pays me in April based on the accounting statement. And last year's, it will income statement, it will show in accrual. Cash flow, it will show negative. And next year it gets adjusted. That is pretty much normal. But over a period of time, it should reconcile. And that is where I've given this ratio of cash flow from operations divided by PAT. At least 80% of your profit should reflect in your cash flow from operations over a long period of time. Now, if this ratio goes down consistently in even the average which I've calculated here for like almost 10 years average, if this is like 20%, 30%, 50%, that means there is a significant leakage between the accrual cash, income which is shown on paper and actual cash which is received to the company. So this one line item which I've covered here will make your life so easy in terms of tracking whether the company is fooling you or it is actually making money. If this was bulb on, just type bulb on in the comment box. Okay, so this is how you go deeper in terms of understanding your, accrual system and also understanding whether actually the money is coming inside or not. Okay, now another important thing is capex. Okay, whether the company is reinvesting money into creating new capacity. That is what you can go through in the capex, and then whatever net amount is remained, that is called free cash flow. Now, a lot of time people have this obsession around free cash flow that, okay, my free cash flow should be always, high and it should be increasing. That is not the case, because free cash flow will be after all these capex and everything. Now imagine a company can expand very, very fast by putting money into growth, by putting money into capex. Do you think they should put money for the growth, or they should not put into capex and just increase their free cash flow just for the sake of increasing it? The answer is no. You should actually put money back to the business as much as possible. And that is what we will get through this particular ratio, which is reinvestment rate. How much is the capex divided by the money you are getting inside the business? So if the reinvestment of the company is being done at a higher ROCs, again, very important note that it should be along with the return on capital employed, like how much percentage you are going to get from that capex. Okay, so that gets covered here. So you should look for at least 30% on an average which reinvestment a company should be doing. And this applies to traditional industrial companies. If you do a banking sector analysis, this might not apply. If you are having an insurance company, this might not apply. If you are doing an asset light company or a platform company like CDSL, this might not apply. Okay, so the capex is a term traditionally for the industrial companies which needs to put actual assets and big factories to operate their business. This is where it will apply. Okay, then you have combination of all the ratios which are out there, right? So we have income statement ratios, all the balance sheet related ratios, and here also very important, one of the ratio is debt to equity ratio, whether the company is too much leveraged or it is having a reasonable leverage. So if your debt to equity goes above like 2 times, 3 times, it's again an alarming sign. The company is taking too much of debt to grow. Okay. And then finally, we have a very powerful model which is called Dupont analysis. Now, how many of you have done Dupont analysis earlier? Just type done in the comment box if you have done it. Okay. Now I'll tell you what the Dupont analysis is all about. And what is the significance of Dupont analysis, right? So the Dupont analysis basically breaks down return on equity. Okay, it's like breaking down ROE. What is what is the return that the equity shareholders are getting ultimately? Okay, so that is where you break down in terms of the source of that return, like where my returns are getting generated. So that is a very, very simple tool in terms of breaking down ROE. And if you see here, if you double click on this, the ROE is broken down. There are 2 types of model. Okay, so one is 3-stage model, one is 5-stage model. So if you see, the ROE is broken down in terms of net profit margin, asset turnover, and then equity multiplier. Whether you are generating big return on equity by selling premium products. Okay, so if you open up a Dupont analysis of a premium product company, like if you open up for Titan, if you open up for Louis Vuitton, if you open up for Nike, you will see that they are selling high margin products, and that is where their returns for the equity holders are bumping up. So you will see those kind of companies net margins are higher. Anything which is a high volume game, those who are playing high volume game like steel companies or your DMart kind of companies, you will see net profit margins are wafer thin. But they might be doing higher asset turn, right? So they might be producing a commodity. So they might be churning their factories 24/7, like your steel companies or cement companies. But Louis Vuitton or those kind of premium product companies will not be manufacturing like thousands and thousands of purses and shoes and all those things, right? It's not a mass product, it's a class product. So there you will see the asset turns are slightly lower. But in commodity kind of company which are playing volume games, you will see asset turns are much higher. Now some companies amplify the return on equity just because their business are commoditized, their net margins are very thin through leverage. Okay, so they will take a debt at 8%, they will put it and generate a return on capital employed at 12%, and that is how they will magnify their ROE. So in those cases, you will see the equity multipliers are higher. Okay. And then if you further break down this net profit margin, then it is consisting of operating margin, your interest burden and your tax burden. If a company, if it is very heavily taxed, then net profit margin might shrink. So those kind of industries which are heavily taxed, you will see that tax burden as a percentage is much higher. Those companies which are having too much of interest, and because of the interest burden, the net profit margins are dipping, you will see this, going in that direction. And then it is again operating margins which are given. So again, this 3 stage is broken into like tax burden, interest burden and EBIT margin. And then remaining 2 are exactly the same. So in this way, you can actually see through the business, like where actually the return on the capital they are putting up, how it is getting generated and what is driving their returns, whether it is a volume game or whether it is a premium game or a combination of both, whether it is due to high debt, high leverage, the company is making more money, or whether, their money is getting squeezed out due to tax or interest, or what is exactly happening inside this company. So this is how, the Dupont analysis is one of the very powerful analysis which you can use and leverage to enhance the understanding of your thought process. Okay. So that is how you go about it. Again, if you are not yet following me, I'm Vivek Mashrani. I'm a TechnoFunda investing specialist and hope you enjoyed this video. If you are not following me on Twitter, you can just go and check it out, my profile on Twitter as well, @MashraniVivek. And if you have any questions, we can do a quick Q&A so that all your doubts are super clear. And as I mentioned, I have a special gift for all of you. If you are not yet part of my community, join this masterclass and you will be able to learn so many things during that session. So if you have any questions, please feel free to ask me and we can go deeper and I can answer you around this Excel. But hope this Excel will be super useful for all of you to analyze the companies of your choice, go deeper inside it and ask relevant questions and not spend too much of time reading like abruptly 10 years annual report and not having that focused approach, right? So I'm sure this will give you a focused approach to your investing journey. And there are a lot of other videos which I just want to mention you if you're not gone through this channel where you can leverage in terms of sector analysis. If you want to understand which are good sectors in 2023 and beyond, this is the video you should go for. Just search with top 5 sectors, Vivek Mashrani, and you will be able to get it. If you want to start budgeting your overall finances and track your expenses and save money and invest properly, this is the video you can watch in. And we have one more very powerful video. If you want to learn more tools, like I just showed you about how to use Excel, screener in terms of template. There are a lot of other tools which you can use. So you can just search with top 5 stock market analysis tools, Vivek Mashrani, and you will be able to find that as well. And if you have not read my book yet, just go for it. It contains this entire machine formula, and I've gone deep dive in terms of analyzing and explain a lot of case studies, how you can invest properly and how you can do stock analysis properly, right? So it's available on Amazon. You can just go to technofunda.co/book, or you can just search with You Can Compound in Amazon and you will be able to find it. So happy to take any questions. If you have, let me know and we can go deeper into it so that your doubts are clarified. Okay. So first question is from Rajiv. He's saying like, be it core or satellite, what should be stop loss percentage? Does your webinar cover or silver system? So yeah, basically, so your core portfolio, you should have the fundamental as a core principle to screen the stocks, and your exits should be more conservative. Okay, so if it goes down by 5-10%, you should not be worried about. If there is entire market fall and your stock is also falling, say you are holding Eicher Motors or Page Industry, entire market crashed and your stock also crashed by 10%, you should not worry about it, right? But if the market is not falling, say your Yes Bank is falling like 30-40% every day, then you should be scared, like really what is happening. Okay, so your exit system there should have like around 30 to 35% in a normal scenario where the market is not falling. And for the satellite portfolio, the things are moving very fast. You don't know whether they have a good track record. You are still, analyzing the company. The earnings triggers are still probabilistic in nature. Whether it will materialize or not, it is not very, very sure. Sometimes you might be having cyclical sectors there. So there your exits might be slightly more tighter. And what I do inside my community is we have an entire live implementation program, which is called Hackathon, which we do with our community members. And if you want to join that program, you can just go to this link and you can join this community. Okay, so you can go to technofunda.co/join and you can be part of my community as well. Okay, so let me just hide this other button so that you guys can see this link. Okay. But yeah, it basically, we have a deep dive session in terms of system building, and we pretty much cover that inside our community. Okay. Any other question? Okay, so Ruhun is saying, trying to check out what all you are explaining. Great way of explaining things. Thank you so much, Ruhun. Glad you liked the session and glad that you got a lot of insights. Thanks for the great session. Thank you so much for being till the end. Really means a lot. Okay, we have somebody asking that, do we have any checklist as per the priority regarding the parameters in the Excel? So this is available for my paid members. We have an entire checklist which we have as a part of core portfolio blueprint module, and even financial statements we dissect in a much simpler and easier way. So if you are considering going through that, you can of course anytime join the community to know more. And of course you can join the session which I'm conducting very frequently. Let me give you the link of the session which you can be part of. Okay, so you can go here. For satellite portfolio, what tools to use? So that I've covered in this particular video. You should go and check that out. So go to this particular video, top 5 stock market analysis tools. There I've covered other tools like MarketSmith and ridewinners.com, and how you can use Tijori and all those tools in a much effective way. That is where you will get much deeper understanding of that. Okay, so thank you so much for asking that question. What else? How much money required for stock market? So Jayanta Das, I would say you can start as much as from 1,000 rupees also, right? It's about that compounding mindset. Each rupee you put in for investing into a business will keep growing if the business also keeps working in your favor, right? So it's not about money. It's just getting started and then gaining money on the way and increasing your allocation. Okay, so start with even 1,000 rupees, test the waters and see how it is working for you. Slowly increase your amount, and then you can get much more better confidence in terms of investing. Okay, what's the scope of IEX? So VM Anand, I cover a detailed session called stage analysis inside my community. It's there in my book also. Right now IEX is stage 4. So I generally don't prefer companies which are in stage 4. Okay. Jay Shah is saying, yeah, great session. Please do share of links of all videos. Yeah, I'll definitely put it inside description so that all of you can check it out. Thank you so much for your compliments, and glad that you liked the session. Yeah. Awesome. So I think most of the questions are answered. Once again, thank you so much for being till the end. I'll place, the links, relevant links in the description and also in the comment section. Let me know how you felt about this session. Also write a quick summary of what all you learned in this session. And if you want to see any other topic and you want to learn more inside this channel, please feel free to type in the comment section, and I'll definitely try to help you out on that particular topic. Thank you so much again. Take care and God bless. Bye-bye.